Okay, good day everyone. This is Lendlease REIT second half and full year financial results for FY 2024 dated 5th August 2024. Right, we'll look at their financial performance. Okay, gross revenue and net property income are up 7.8% and 7.4% year on year. Right, but we'll see later that this is not so relevant. Right, distributable income and DPU, which we are more concerned about, is actually down 15.6% and 17.7% year on year. Right, so these are things we are more concerned about, and it's mainly due to the fact that the interest costs have gone up quite significantly. Right, gearing ratio is 40.9%, but if we include perpetual securities, this is closer to 50%. Right, weighted average cost of debt this year is 3.58%, which is quite substantially higher than last financial year. Interest coverage ratio is 3.2%, but this does not actually 3.2 times, but this doesn't include perpetual securities. So I would prefer to consider perpetual securities as debt. So for me, I'll use adjusted interest coverage ratio, which is, I believe, 1.7 times. Right, fixed borrowing cost is fixed rate borrowings are 61%. Right, this is the slight positive of their balance sheet because I think a lot of other REITs have actually their borrowing costs fixed up to 80%, so they may not benefit so much from the drop in interest rates. Right, so this may be a slight positive. Right. Right, I consolidated numbers from FY23 to FY24 primarily because before that they didn't have GEM. Right, so first half 2023 is the first time they include revenue from GEM, and before that numbers were substantially lower, so I didn't want to include it. Right, so if we look across the board, we look at a surprising bump in gross revenue in first half 2024. All right, but this actually due to the supplementary rent from the lease structuring with Sky Italia in Milan. Right, so basically this is a one-off bump in money they get from Sky Italia, right, for them to refurbish the building. Right, so if they remove that, right, then I think the number will be something like 106,914, right, which is maybe about 3% higher, right, so not that substantial at 16%, right, and then you see second half 2024 there's a slight drop, all right, from 106,914 to 100,988, and this also includes supplementary rent. All right, therefore net property income has the same issue as gross revenue, right, because this revenue recognition, right, is for basically supposed to be for 2 years, right, so the revenue is recognized upfront, but management did say that they won't one shot distribute the money to unit holders, right, so they have spread out the cash such that they will try to evenly spread out over 2 years, right, so next year when this revenue is no longer recognized, right, we expect a drop in revenue, right, but it shouldn't affect the DPU that much because the cash recognized earlier would be saved for next year's distribution, right, so that means they tried to distribute the amount they got from this supplementary rent evenly across the next 4 halves. Right, so that explain the gross revenue and NPI bumps and drops here, right? Then DPU's slight and distributable incomes and DPU slight, right, is more explained by the jump in the cost of interest on their debt. Right, so if we look at 1.77, if I analyze the year, right, that means if I take 1.77 for second half and multiply it for a full year, I'll just take it 1.77 times 2, right, then I base off today's unit price of 0.61 cents, right, actually the yield is only 5.8%, right, annually. Okay, so just a sense of how the REIT is being valued right now. Right, anyway, the blue color things are the year-on-year numbers, all right, the red color things are first half year-on-year numbers, right, so that means to say blue color is for the full year, red color one is for the first half, right, so why? Because they didn't really report the second half, so I'm trying to get an estimation for what's going on in the second half of the year, right, so full year occupancy is 89.1%, right, first half was 87.9%, so this is an improvement, right, we're happy with that, right, first half the tenant sales was plus 0.6%, full year is plus 0.2%, which means I believe the second half actually dropped by minus 0.4%, right? So correct me if I'm wrong, but I think I should be correct in that estimate. Right, rental revision, you can see that this is the strong part of the REIT. The properties are clearly very good. assets, the rental revision for the first half of was 15.7%, right? And full year was 14%, which means second half actually is worse than the first half lah. Maybe I estimate second half retail rental revision to be around 12 to 13%, somewhere there, but it's still decent, pretty good, pretty strong, right? The rest I don't think I have too much to say about, right? So we just move on. Right, so we talked about this earlier. Gross revenue and NPI are actually boosted by the supplementary rent received from the lease restructuring of Sky Complex, right? And if we exclude the supplementary rent, right, FY 2024 still performed okay in terms of general operations because gross revenue and NPI are up 3.2 and 1.3% respectively, right? So even without that revenue bump from supplementary rent, gross revenue and NPI was still up, right? However, second half not so good because you can see that even if they include the supplementary rent, gross revenue was only up 1.4%, whereas NPI was actually lower by 2.6%. Right, so against the backdrop of high interest rate environment, borrowing cost year on year was higher for the financial year ending 30th June 2024, with weighted average cost of debt at 3.58% per annum as compared to 2.69% per annum in the previous financial year. So this is a big jump in the cost of their debt, right, which explains why the DPU keeps sliding down, right? So yeah, consequently, distributable income and DPU were lower in FY 2024. Right, we look at the debt, right, this amount of debt is currently already, they're trying to renegotiate the terms of this debt. Right, so we look at their capital management. I don't think there's too much to say here, except interest coverage ratio. I'll look at 1.7 times for adjusted interest coverage ratio rather than looking at 3.2 times, which does not include their perps. Right, their retail side is doing very well. So GEM is 100% occupied. All right, 3 on 3 is 99.9%, right? You can't complain, right? And rental revision is high as well, right? 14%, right? So that's great. Tenant sales, not that good. The increase is not very substantial, but at least it's still increased 0.2%, right? Visitation approximately improved by 3%. Right, so Singapore office side, they have this office lease to the Ministry of National Development, which is very you don't have to worry about this going bankrupt, right? Because they are a government entity, right? They definitely have cash flow to pay their rent, right? And then for Milan, building 1 and 2 are fully leased to Sky Italia, right? And building 3 is undergoing repositioning to secure multi-tenancy and market rate. So I think this is the part where they're trying to lease it out, right? Later on, we'll talk a bit more about this. Right, so we look at the valuation of their properties, right? So why this REIT is a good thing is because a lot of their properties is based in Singapore. You see the big valuation properties are all based in Singapore, GEM and 313 and Somerset, and both have positive rental revisions, right? So this covers up Sky Italian's like 10% or to 11% drop in valuations, such that the overall portfolio valuation is still up 0.9%, right? So this is the good thing about Lendlease, because most of the properties is based in Singapore, the valuations can hold their value well, right? Versus other REITs like, for example, the US office REITs, when the valuations fall drastically and suddenly their gearing just shoots up, right? Even though they didn't take up more debt, and then the bank don't want to lend them any more money, right? So luckily, Lendlease, their good fortune is that even though their balance sheet is not very strong, right, their property is in Singapore lah. So that's their saving grace, right? So overall, property valuation is still up by 0.9%. Okay? Yeah. So anyway, the big overhang on this REIT for me has always been their perpetual securities, right? So they have two perpetual securities, one with a reset date at 4th June 26, the other one in 11 April 25, right? So what they can do with this is that they can don't do anything, right? And if they don't do anything, the 5.25% interest rate they are paying will just probably just rise to around 6%, right? Give and take a bit lah. All right. So that will be an increase in borrowing costs, which again may cause DPU to fall. All right. Sorry, I cannot remember where this report came from. Either UOB or DBS, right? Anyway, they suggested that they may divest the office block at GEM, right, which is leased to the Ministry of National Development, discussed earlier. But I don't think this is in the works because when the CEO talked, he didn't say anything regarding this, right? So anyway, they have 10% stake in Parkway, all right, and the MRT actually I think it's done, right? So the footfall at Parkway apparently anecdotally observed by the CEO, he said that the footfall seems higher, right? But he didn't reveal too much, right? This is the space that has been dragging for a very long time, right? There's a multifunctional event space adjacent to 313 Somerset that is supposed to be built, but it's been delayed for a long time, and the CEO offers an explanation for why later, right? So this based off an interview with the CEO on 6 August 2024, right? So he talked about the fact that Parkway Parade and PLQ are in the pipeline to be taken over. However, not in the near future because PLQ I think is a $10 billion asset, right? But the low share price of Lendlease now means that acquiring them will not be good for shareholders, right? So it's not in the works in the near future. For Parkway Parade, again, the same idea applies because of the low valuation of the stock price now. Doesn't look like they are going to acquire it in the near future, right? So the Sky Milan revenue 2 years front loaded, but the DPU they try to spread it across 2 years. So that means to say the revenue is recognized in I think roughly all this year, all right, but they will spread the DPU across 2 years so that the DPU is not so lumpy, right? The revamped Sky Milan, right, is not even 20% occupied now, but he seems very bullish, all right? So this is just from the CEO's speech itself. He said that he aims for every part of Sky Milan, right, to get 50% more rent for the space as opposed to before, right? So that's a very ambitious goal, right? So he claims that so even if I fill 70% of the new Sky Milan, right, I can replicate the old rent already. I don't have to even fill the full space. So he's very optimistic. Let's hope it's true. All right. Anyway, hold back to the Grange Road car park. I don't know if I got this spelling correct, but it actually refers to this one. I think the multifunctional event space adjacent to 313 at Somerset. Right. So he said the approval, there's some hold up because of some regulations and agreements, but once they can approve, it will take 12 to 18 months for construction, and he believes that this will be a long-term thing that will contribute to the revenue, I'm sure, of 300 Lendlease REIT. Okay, yeah, no AEI to 313 in the near future. All right, he said that this 313 is trying to position itself to be less tourist dependent, which I like. All right, and they want to attract more young professionals. And I do think that they do have events there that seem to draw the younger crowd, right? Then he was also queried on utilities costs getting higher. It's about 15% of the operational cost, right? He said that next 2 years likely got savings from July onwards of 2024, right? 30% discount, right? And he said he may boost DPU by 0.2 to 0.3 cents, right? That's off his words. I hope I heard it correctly because he was just verbally talking about it and there were no slides to have a look. And that's quite substantial because based off the latest DPU, it's an 11% boost to DPU, right? So that's all for my sharing today. Please note none of this is advice to buy or sell, right? The REIT has not a very strong balance sheet in my opinion, right? And but it looks like there are some good prospects going on, right? Okay, that's all. Thank you for listening.